Welcome everyone to today's webinar. My name is Bernal Baker, one of the financial consultants with Alliant Retirement and Investment Services. It's important to acknowledge that there is no one single perfect finance plan. Every option comes with its own advantages and limitations, and no one approach works for everyone. At Alliant Retirement and Investment Services, we understand that each family's situation is unique. In this presentation, I'll share some key insights to help you make informed decisions about planning and savings. Our team at Alliant Retirement and Investment Services is focused on helping you understand the ins and outs of investing, saving for retirement, and much more. Take a look at our website, ARIS.Alliantcreditunion.com, to see our list of weekly webinars, our podcasts, Invest Savvy, our blog, and other financial resources. So, how can we help you? First of all, we want to get to know you and design a plan for your specific needs. Then we use a team approach for your particular situation. And lastly, we want to build a lasting relationship for life. Now, let's get into the real reason why you're here. In theory, using credit shows we have confidence in our future ability to pay. In practice, though, we often use credit for just the opposite, when we can't actually afford a purchase. One reason many people overuse credit is that they're living from paycheck to paycheck and have no cushion for emergencies. But in the long run, using credit as a cushion can lead to debt and undermine efforts to build savings for important goals. Amassing debt isn't difficult today. We are bombarded with advertisements for thousands of must-have products and inundated with credit offers, pre-approved credit cards, increased credit limits, and department store lines. What can get you into trouble is the inability to use credit wisely. Spiraling credit card debt often comes from impulse buying. But no matter what your income is, you can dig yourself out of debt by spending less than you make. That may sound simple, but first you've got to know exactly how much you are spending and find ways to cut back. For many people, the hard part is just getting started, but you have a leg up. You're here today to learn to manage your money more effectively. We'll begin by analyzing your expenses and your spending habits. Then we'll discuss how to use debt wisely. You'll learn how to create a budget to address both your debt and your spending needs, with an eye towards building savings for the future. And I'll show you how to reduce debt and stay out of financial trouble. After today's webinar, you should be prepared to change your financial situation for the better, perhaps in as little as 6 months. What you first need to do is create a personal balance sheet, itemizing your debt as well as your liquid assets. Total up your liquid assets, including any savings and investment accounts. Do not consider amounts in IRAs or other retirement plans. Calculate how much you would need to cover a minimum of 3 months of living expenses and subtract that amount from your assets. You'll want to give yourself this cushion in case of some unforeseen circumstances, like losing your job or a medical emergency. Also subtract any major purchases you expect to make in the next year. What remains, if anything, are your net assets, assets from which you could start to pay down your debt. Next, you'll want to list your debts in order of interest rates, from highest to lowest. Debt comes in many forms, some quite useful and necessary. 40 years ago, your parents may have paid cash for their homes or their cars. If you have a mortgage or an auto loan, you are carrying what is called installment debt, meaning you pay a portion of the total due at regular intervals over a given period of time. Installment debt helps us get what we need when we need it. Similarly, school loans and small business loans can be a valuable investment in your future. Carrying credit card debt, on the other hand, is usually counterproductive. Let's take a closer look at those little plastic traps. Do you know the interest rates charged by each of your credit cards? The average APR on a new credit card offer is currently 7.65%. But fierce competition forces some companies to offer a better deal. Yet, you may pay rates of 20% or more. Keep in mind that many credit card companies offer lower rates for an introductory period only. But if you can find a card with a reasonable rate and no catch, consider transferring your balances. Why pay 20% interest when you can pay 8 or 9%? Why pay annual fees? Many companies will waive them. How many cards do you carry? If you are carrying a balance on each card you have, you've got a better chance of losing track of your balances. Limiting the number of cards you use can help you keep tabs on your spending. We'll talk more about how to eliminate extra cards later on. A recent change in banking regulations require higher minimum credit card payments from millions of American consumers. The idea behind the payment hike was not to hurt consumers. To the contrary, it was supposed to help consumers pay down their balances faster, with a larger percentage of their payment going towards principal instead of interest. Generally, where credit cards previously required customers to pay off 2% of their outstanding balance each month, most now require customers to pay all monthly interest and fees and pay 1% of outstanding principal. The minimum payment is a fraction of your overall balances. Under the standard payment system, if you continue to pay only the minimum required, you would pay primarily interest on the debt, and you could stay buried in a never-ending cycle of payments, especially if you continue to use the card. The longer you carry a balance, the more total interest you will pay. Let's assume you have two debts of $2,000 each. One is in the form of an installment loan with a fixed payment each month. The other on a credit card that charges a monthly minimum payment based on your balance. Both charge an interest rate of 18%. The first minimum monthly payment on the credit card would probably be 5% of your balance, or $100, and a minimum monthly payment of $10 thereafter. If you continue to make the minimum monthly payment after that, as they gradually decreased, it would take you 89 months, that's more than 7 years, and cost you more than $800 in interest to pay off that $2,000 balance. But your installment loan would charge you $100 every month, and you would pay off the entire balance in 24 months, for a total interest cost of $394. Of course, these examples are hypothetical and for illustrative purposes only. Your actual results may vary. The way to pay off debt on a credit card is to treat it like a loan, or in other words, pay a fixed amount every month. A little later on, I'll get into more details on exactly how to do this. The average credit card debt in America is about $6,380 per household. We can calculate a debt-to-income ratio to get an idea of where you stand. First, tally up all the payments you make each month to credit card companies and other creditors. Exclude your mortgage at this point. Divide that figure by the amount of money you take home each month. If you multiply that result by 100, you'll get a percentage of the ratio of your debt to your income. As a general rule, if your debt-to-income ratio is less than 15%, you may be in pretty good shape. Anything more than 20% could indicate trouble. So, how do you start to dig out from under this debt? Start by finding out where your money goes each month. Take a few minutes to write down all your typical expenses for 1 month. Make sure you fit all your expenditures somewhere. Total your expenditures and write down your monthly salary after taxes. In other words, the amount you actually take home. Are you spending more than you take in? If so, you'll need to identify where you're overspending. Take a closer look at each category. Where is most of your income going? Is the dining out category more than groceries? Is entertainment a big chunk? You may need to cut back or compensate by trimming somewhere else. Can you decrease your spending in other categories to allow for more to go towards debt payments? Let's find out by creating a monthly budget in which you can designate a set dollar amount for each category, including debt and savings. As you get a more precise picture of your monthly spending, you can modify the plan to fit your needs. You should create savings by budgeting for it each month. Treat it as a bill you need to pay. Financial professionals recommend saving 10% of your income each month. Building savings is key to reducing debt because you'll have money to fall back on in emergencies. Avoiding using those credit cards. Remember that although a review of old spending habits can help you determine realistic figures, your budget should be a guide for allocating your income wisely. With the information from 1 month, create a draft 12-month spending plan. Be sure to include your new savings and debt reduction figures. You'll want to include all sources of income and all fixed and variable expenses. When you go home, you can use last year's pay stubs, credit cards, and bank statements to help you fine-tune your plan. It does little good to make a budget you can't stick with, so be realistic and remember, the plan is a draft. You may need to modify your strategy to accommodate changes in your situation. Paying off your debt is usually one of the best investments you can make, and it's entirely risk-free. If you have savings, consider using some of that money to pay down your debt. But why give up part of your savings? Because you actually save more over the long term by getting rid of those interest payments. Let's take a look at an example of how this works. Let's take a look at two scenarios. First, say you owe $1,000 on a credit card charging you 18% interest. Meanwhile, you have $1,000 in net assets, not including your 3 months of living expenses, sitting in your savings account, which is paying 1.25%. At the end of the year, you would have paid out $180 in interest on your credit card balance and earned $12.50 in interest on your savings, resulting in a loss for the year of $167.50. But if you had taken your savings and used it to pay off your credit card debt, you would have broken even, a much better result. Another option might be to take out a low-interest loan to pay off your debt. If you have substantial equity in your home, a home equity line of credit may be especially appealing because the interest paid is generally tax deductible. A tax advisor can help you determine if this may be appropriate for your situation. If you don't have a lump sum to pay off your debt all at once, you can still save on interest payments if you gradually decrease your credit card or loan balances by paying more than the minimum payment. You can gradually pay off all your debt this way. From your monthly budget, designate a set amount to pay each month on each balance you carry. Allocate the highest payment to the card or loan with the highest interest rate. As each balance is paid off, add those payments to the next card or loan until all are paid off. Set up a realistic payment schedule and stick with it. If you need to, adjust your schedule. It's better to set up a realistic payment schedule and stick with it. If you need to, readjust your schedule. It's better to set yourself back a little than to give up entirely. By using something like this calculation, you can estimate how long it will take to pay off each debt, given your current payments. Then, for comparison, run through the calculation a second time, using the new payment amount you budgeted. Remember that the longer you retain a balance, the more total interest you will pay. Once you reduce your debt burden, take steps to prevent it from returning. Limit your use of credit cards. By carrying 1, 2 at the most, you can lower the temptation to charge. If you put all your purchases on one card, you'll have one statement. It will be easier to track your spending. Use the second one for emergencies only. Cancel credit cards that charge a higher interest rate. Leave your cards at home unless you really need them. Make saving simple and automatic. First, establish a savings account. Then, deposit budgeted amounts into checking. The rest of your money goes into savings. Finally, set up automatic monthly transfers from checking into savings or investment accounts. Today, you have likely identified a need to modify your spending behavior. Following these basic guidelines may help. Think about purchases before you make them. Think of needs and priorities. Can you explain why you need to make that purchase? If not, don't make it. Use cash or debit cards whenever possible, even if it's just for partial payment. Charge the rest only if necessary. There are other ways to save too. Examine insurance policies for potential savings. You can raise deductibles and eliminate unnecessary insurance policies. Determine if any assets can be sold, especially items that you are making payments on but not using very much, such as a boat, snowmobile, etc. It might sound obvious, but be conservative in your use of utilities, such as your gas and electricity. Try cutting down on pleasure spending, such as shopping trips or eating out. Buy in bulk at discount stores, use coupons, or buy generic goods. Make a list before you go shopping and stick to it. Again, how can we help you? First, we get to know you and design a plan specifically for you. Then we use a team approach for your particular situation. We want to build a lasting relationship for life. I hope you learned an item or two that will help you improve your situation. Thank you so much for attending today.